the price that we pay to borrow money from a bank or from a lender. And there are different measures of interest rates on the market. So we're looking at the different types of interest rate measurements on the market. We looked at the coupon interest rate, bank equivalent rate, yield, bank rate, equivalent rate, or bond equivalent rate. We looked at the current yield to maturity. We also talked about measures of interest rate on financial assets in terms of a bond, how a bond is being sold on the market. We have a discount bond, a premium bond, and a par bond. And in what circumstances will we see that this instrument is a par instrument, or it is a premium instrument, or it is a discount instrument? We need to observe their coupon rate and their yield to maturity. So if the coupon rate and the yield to maturity are the same, we say that the bond is a par bond. If the coupon rate is higher than the yield to maturity, the bond will sell at a premium. And if the coupon rate is lower than the yield to maturity, the bond will sell at discount. Then we also talked about holding period yield or holding period return, which is the same interest rate or the rate of return which is being stated on our investment. Then what again did we talk about? Yield asset prices relationship, a situation whereby there is an increase in demand for funds, and another situation where there is an increase in the supply of securities. How will it affect interest rate on the market? We discussed that one. Then we also talked about simple interest rates, and what we're on that I said it requires time is this one, the add-on interest rate, the add-on interest rate. I believe that we have our calculators beside us because we are going to do some small calculations today. With the add-on interest rate approach, it is so simple. Most of the time, when you go to the savings and loans or the microfinances, and you are going to the 10%, it's cut across, and the loan amount to that the person pays, it doesn't change. So the interest is being charged on the principal, but not on the reducing balance. Normally, under normal circumstances, when you go for a loan from a bank, the interest is charged on the reducing balance method. But with the add-on rate, it is not like that. So even as you are paying the principal, the interest is the same. Then they also divide the principal over the period for you. So if the money that you borrowed is 5,000 and you borrowed it for maybe a period of 5 years, let's assume you are paying it on a yearly basis. You divide the 5,000 by 5. That will give us every year you are paying 1,000. Then if the interest rate also on it is maybe 10%, so 10% on 5,000 would be 500. Now, once you divide the 500 by 5, that you are going to get 500. Every year, you are going to pay 1,100 for a 5-year period. And at the end of 5 years, you would have finished paying your interest plus the principal. That is how the add-on rate approach works. Please, do you understand?
Yes, madam.
Okay, so for us to understand better, let's take a question. Please write. SY company has borrowed an amount of SY company has borrowed an amount of 25,000 cedis. Has borrowed an amount of 25,000 cedis at an interest rate of 8%. XY company has borrowed an amount of 25,000 cedis at an interest rate of 8% from Cal Bank. At an interest rate of 8% from Cal Bank. at an interest rate of 8% from Bank. Calculate the total interest if the borrower is to pay over a period of 5 years.
Madam, please, your voice is going on and off.
Oh, sorry. But I hope you had up to Bank.
No,
Yes,
the interest rate.
Okay, you let me read it. Let me say it again. XY company has borrowed an amount of 25,000 cedis at a rate of 8% from Bank. The interest calculation is based on add-on interest approach. The interest calculation is based on the add-on interest approach. Calculate the total interest. Calculate the total interest. Calculate the total interest on monthly. No, calculate the total interest. If the borrower, calculate the total interest. If the borrower is to borrow over a period of 4 years, calculate the total interest. If the borrower is to borrow over a period of 4 years with monthly payments.
If the borrower is to borrow,
calculate the total interest if the borrower is to borrow over a period of 4 years. With monthly payment. I'm trying to put the question in the chat. I'm typing. Okay, so I've pasted a question. Have you seen it?
Yes, madam.
Okay. So, a company goes to Bank to go and borrow an amount of money. Now, with the add-on rate, it works like the way the simple interest rate works. That is a basic thing. Now, what we are saying is that this company takes an amount of 25 million from a bank for a period of 4 years. Now, With a period of 4 years, the bank is charging them an interest of 8%. An interest of 8%. And the money that when they are paying back the loan, they are not going to pay it on yearly basis. They are going to pay it on monthly basis. Now, how the add-on interest approach works is that if they are going to pay it on monthly basis, then we are going
Okay.
we are going to get it as the number of periods, right? So if the company is going to pay back the loan, that is the principal, they are going to pay it on 48 times. So if they took a loan of 25,000 cedis, and every period they are going to pay for 48 times, then for each period when they are going, how much would they pay? So the amount of principal to be paid will be the loan amount they took divided by the number of periods. Are you with? About the interest. The interest that they are charging is 8% on 25,000 cedis. So we have to put it in a periodic state by dividing the 8% by also 12 periods. Then we multiply it by the amount of money that we took. So when you do that, each period, how much interest will the principal borrower pay? Do you understand? Or pay it on a monthly basis. And we have identified that we are going to pay it over 48 weeks, 48 periods. That is every month for 48 times. Do you agree on that? So if that is the case, then every month, how much are we going to pay? So you have divided the 25,000 by 48, and all of us have 521 cedis. Are we okay with that one?
Yes, madam.
Okay. Now that is a principal ask. What about the interest of 8%? And 8% is an annual rate. It is per annum rate. So we have to put it on a periodic basis, on monthly basis. So if you have to put it on monthly basis, have to divide annual interest rate, which is the 8% by 12. So 0.08 divided by 12. That will give us what? Calculate and tell me. I've put it in the chat. What are we getting? 0.08 divided by 12 will give us what? Put the answer there for me.
0.0067.
What did you get? Put the answer there for me so that it will be an interactive. Please give the answer to me. Put it in the chat so that everybody will see. Or I'm off.
No, madam.
Okay. Oh, don't send it to me direct, please. Send it on the platform so that everybody will see, please. Okay, so Abigail had 0.0067. The same applies to Victoria. So for every month, this is the interest that the company is going to pay. So if they borrow 25,000, how much money are they going to pay for first month, second month, third month, up to 48 months? So we have to multiply the 0.0067 by 25,000. So when you multiply 25,000 times 0.0067, what are we going to get? Have I sent a direct message to somebody? Or it is on the platform? Ophelia, is a message directly to you? Okay, thank you. Oh, sorry. How come I'm sending direct message to you? Okay, so you see how much you are getting. Is everybody getting 167.5? No, is it not 16? Is it 167 or 166? Hello? Yes, this is 166.666. Ophelia's is the correct one. So if you have 0.08 divided by 12 times 25,000, that will give us 166.6. So how come some of you are getting 167.5? Hello, those Cecilia. Yes. Cecilia, we're from 167.5. Then Kenneth, we're from 167.5. Yes.
Madam, please, I multiplied 25,000 by 0.0067.
You multiply it by 0.0067.
Yes, please.
But I'm coming, 0.08. Unless my calculator is wrong, divided by 12 gave me 0.006. Or it's 6 in series. Okay. Is it 6 in series? Please answer me. Is 6 in series?
Yes, please.
Yes, it's a 7 at the end.
Okay, that's okay. No problem. So we also had 167.5. And those who also had 166.6. When you run it off, it's 0.5, that's the difference. But you see that you have the interest that you are going to pay. It's 167 or 166, okay? Then the principal that you have to also pay. When we calculated, we had where is the figure? We had 520. Some people had 521. Then others also said 520.83. Have you seen that? So you, the financial manager, when you are going to pay back the loan every month, you are going to pay back
$7.5.
good. Please, is anybody getting that?
So that's the total amount.
That is the total payment that you are going to get.
First for the month.
Yeah, for the month. So for the 48th month, we are going interest you have paid. For us to know the total interest you have paid, we just have to multiply the 166.67 by 48. When you do that, what will you get? The interest payment. When you multiply it by 48, what will you get?
Now,
You should get 8,000.
hello.
Yes, hello.
When you should multiply.
The interest payment,
Right.
when you multiply it by 48, what are we going to get?
And then we get 7992.
7 times 4.
What did you get? If you use those who had 166.67, when you multiply it by 48, you get exactly 8,000. Yes, yeah, that's a serious one. You get 8,000. Now,
I have 8,016.
8,000. No, it is not 16. No, is it not 8,000.16? Yes, I see Christabel.
Yes, 8,000.
What did you get?
8,000.
Madam, I'm confused a little.
Hello, I went off.
Yes, madam. Madam, please, I'm a bit confused. Can you help me? Please, how do you get the 8,000?
Oh, you see, the bank manager took the loan for how many years? 4 years.
4 years.
What is the interest on it?
Yes. 8%.
8%. So calculate 8% on 25,000 for 4 years. What will you get? That is all.
So 8%, okay. 25,000.
Yeah, 8% on 25,000.
That's 2,000.
Hey. For 4 years. For 4 years, so times 4.
8,000.
You had 8,000.
8,000. Yes, please.
So you see that the simple interest something here. In a single payment loan, the simple interest and add-on method gives the same interest rate. However, as the number of installment payments increases, the borrower pays a higher effective rate under the add-on rate, and that is what we just established. So under the simple interest rate, when you calculate, the annual rate will be 8% because the person is paying just once in a year. But with the personal add-on, first of all, You need to know the number of periods that the person is paying the loan. Then you divide it by the amount of money the person took. Then we have to also calculate the interest, the periodic interest. Then we add it to how much principal the person will be paying at any particular point in time. So that is very, very simple. Then we have what we call the discount loan method. For the discount loan method, when you take a loan, the interest that they charge is the rate of 10,000 is 500. Then subtract it from the 10,000 and give you 9,500. That is how the discount loan method is done. So you don't go home with 10,000, but you go home with 9,500. Then we have this one, the home mortgage type of loan. Have you heard of the amortized type of loan before? Amortization, have you heard of that before?
Yes, but I don't know how it's done.
So this is how the amortized type of loan works. Take a question. Okay, I'm coming.
Yeah. Sometimes we get lots of work where we are.
Okay, let me look for Word documents.
We don't even Excel. You can even know them.
No, Excel will not be fine.
Okay, then where did you find?
Let's say to do our calculations. Then you see some difference here. Where is our chart? I don't want to introduce another question. So let's use the same.
Okay.
XY company has borrowed an amount of 25,000. So I'm copying it, then I'll come and paste it at the Word side. Can you see the question?
Yes, madam.
Is this? I hope it's okay.
Yes, madam.
Okay. So SY company has borrowed an amount of 25,000 at a rate of 8% from Car Bank. The interest is based on, let's take this one from there. Calculate the total interest if the borrower is to pay over a period of 4 years with monthly payment deduction. Assuming the loan is a home mortgage loan, okay? So let me write, assuming I'm coming up.
Okay.
So assuming the loan is a home mortgage loan, okay, or in a different environment, you see it to be an amortized type of loan. Now, when you say a loan is a home mortgage loan type or an amortized type of loan, it's normally seen as the reducing balance method type of loan. So the interest is charged on the reducing balance basis. Now, when I go to Car Bank to go and borrow an amount of 25,000 cedis, what Car Bank will do is that for a period of 4 years, now I'll be paying it on monthly basis. So our L that you see here will be equal to the 25,000 cedis. Are we okay? Then our rate is equal to 8%. Then our time, which is our T, is equal to 4 years. Are you with me?
Yes, madam.
Okay. Now, so after the period of 4 years, the interest plus the loan should have been finished paying. Now, with the amortized type of loan or with the home mortgage type of loan too, the amount of money that we pay over the period does not change. It is constant. So that is what we are looking out for. So we are going to identify a cash flow, that is a C. And the cash flow that we are going to identify is being calculated as the loan times this whole figure. Now, if you know how to calculate the price of a bond, you see that it's the same thing. We use the amortized formula to calculate the price of a bond, and that is the formula here. This is put in a different way. So if the loan calculation is being done on monthly basis, then it means that the rate that you see here, the 8%, must be divided. Where is my divide? Must be divided by 12. Do you agree? Then when we divide it by 12, we are going to have 0.0067. Is that the case? I want you to follow. Is that the case?
Yes.
Okay. Then the number of years, we'll do what? We'll multiply it by
12.
You multiply it by 12, and that will give us 48 periods. Okay, so this is what we have. Now we need to input these figures into the formula. So please do it and let me see. The loan amount is 25,000. The rate is 0.08 divided by 12 into bracket 1. Let's open a big bracket here. So you see 1 plus, I don't think we need to go through this. It will be 1 plus 0.0067. Do you agree?
Yes. Yes. Yes, madam. It was R by 12, yes. That's one.
67. Okay, 67. Then we close the bracket. We raise it to the power 48. Okay. Then we are going to divide everything divided by
1 plus 0.067.
I'm coming. So we are dividing it by, let me open my bracket, 1 plus 0.0067. Then we close the bracket, raised to the power 48. Then everything minus 1. So those who have calculators, please calculate it and let's see. Let's do what is in the bracket first. So we are going to have 25,000. Then open the bracket. Those who have done the calculations, please let me have it. 1.0067.
Madam.
Yes, yes. Please stop.
Madam, please. In the yes, in the
So have you now? Yes, thank you. And you people, you didn't see that. So
No.
0.00, that means that you are following, just that you have decided not to mind. Okay. Then we are going to divide it by so 1 point. Please check if my figures are right. 0.00922316. Is it correct? Then divide by. So when you subtract 1 from that, we are going to get 0.00377885. So this figure divided by 0.00377885 will give us 25,123 times 2.443198. Oh, give me the figure you are getting it. What are you getting?
We're working on so.
Madam.
Yes.
So with yours it's 61079.
61079. Yeah, that's what I'm getting. I'm doubting if it is correct. 610.
Also has 610.79.
Okay.
But madam,
That's too big. There must be an issue somewhere.
we
Yes.
have to keep it keep it at 3 decimal place.
Yeah.
That is the 25,000 times 0.009 over yes,
Secondly, to give us what?
600.
Just 600 cedis.
Yes.
If we have to keep it as what? 0.00929 what?
Just 9.
Just 9.
0.009
Yes, and then
divided by
the 3.
0.0037. Okay. That will give us 2.432. That's interactive. I'm using some color calculator here, so I'm asking you 2.434 times 25.
Madam,
Yes.
it should be 0.0. Just 1 0 there. Point
What about the top one?
It's okay.
The 0.009. That one is okay.
Yes, please.
Okay, so divide by 0.0377. Thank you. But we've seen, my lady, thank you. She has corrected us. So it was, see, the way just 1 0 has messed us up. So with my calculation, I had 6121.7. Anyway, approximation will cost a lot of things. What are you guys also getting? Put it on the chat and let me see. So the answer is 6,000 plus. That's what is it. Okay. Okay, thank you. So at least I know that we are all around the same figure. Now let us compare something. You see, this 610, okay, that we are getting, that is what we are going to pay for 48 periods. Do you agree?
Yes, please.
Okay. Now, if you are the financial manager and you are asked to choose between the add-on rate and the amortized rate or the home mortgage type, which one would you choose and why? Now, for us to be able to compare it very well, the 610.79 that you have gotten, multiply it by 48 and see what you get. When you get it,
Madam,
put the answer there for me, for others to see. Multiply 610.79 or 610.77 by 48 months. What will we get? What are you getting? Okay, 29317. Thank you. Thank you. Now, the earlier one we calculated, that is the add-on rate. How much were you going to pay every month? It was 687. Do you remember? Go through the chart and see. It was 687. It was, yes, Ophelia's
yes.
one is here. Okay, now multiply the 687.5 times 48 and let's see what we'll get. When you get it, put it in the chat form, please. 33,000. So do you see the difference? The amortized one or the home mortgage one, we had 29,317. Then the add-on rate, we had 33,000. So if you are the financial manager, which of these two approaches will you choose for your company and why? I'm waiting for your response.
Madam,
Yes.
please, in
Whose hand is up?
layman's
Who
term,
just called me? Which one will you choose?
Victoria,
Yeah, but which one
I
will you
will,
choose?
I'll choose the second one, the home loan approach,
Okay, why?
because I'll be paying less compared to the add-on interest
And you
rate.
know the
And
reason
secondly, it
why?
will be a bit closer to.
Do you know the
Please come
reason
again.
why? Do you know the reason why you are paying less with the home mortgage one? Oh, it is not only to Victoria, to the whole class, please. Yes, who wants to talk? Emmanuel.
I think about it is quite thing. They tried the interest from it. The first took the interest.
Again,
They took out the interest.
No, the interest is, they took out interest from what?
Okay, I thought from the principal.
No, you see, home mortgage one, when you pay here,
Yeah.
the interest is calculated on the reducing balance method for you. Are you with me? But with the add-on rate, the interest is calculated on the principal throughout. So even last year, if you have paid maybe about 20,000 of the principal and you left with 5,000, the add-on rate was still calculating the interest on the 25,000. But with the home mortgage, it will be calculating the interest only the 5,000. Are you with me?
Yes.
So at the end of the day, you see that the home mortgage or the other type of loan is cheaper than the add-on rate. So normally in corporate finance or in business finance, you ask you to prepare what you call amortization schedule. So when you prepare the amortization schedule, you see the amount of principal that you have paid for each payment that you do. Okay. But for our class, we end it here. We don't ask you to prepare the amortized schedule. When we meet face, we are going to do duration. So you do duration calculation with the same formula. Then you have the annual percentage rate. When anybody goes to the bank to go and borrow, the quoted rate is what you call the percentage rate. And the annual percentage rate, a lot of things goes into it. Transactional fees goes into it, service fees goes into it. And now the loans that the bank gives out, there is a portion of it that is the insurance portion. In case the borrower dies, the insurance company will take care of the rest of the loan. All those things goes into the calculation of the annual percentage rate. Then we also have the compound interest, which is used to calculate the future value of our investment. So this is the present value of the principal, the rate divided by the M, that is the monthly or quarterly or semi-annual daily basis, they are using 365 divided by D. So if you go and borrow, or if you put money in our account and the bank decides to credit our account on the interest is on daily basis. So what interest did they quote per annum? They quoted 12% per annum. So every day, how much are they charging us? It will be the 12% divided by 365 days. This topic, then we do a more theory question where you finish in less than an hour. Okay, so we are going to do this one, the rate structure of interest rate. This is basically theory. There is no calculations in it. So by 2 o'clock, we should finish with this.
Your voice is far behind. Your voice is far behind. Your voice.
My voice is okay.
Hi.
Sorry. Is it better?
Yes, it's better now.
Okay. Thank you. We are going to look at the effects of some characteristics or some attributes on interest rates and net prices. How these characteristics of financial assets affect interest rate determination and also affect the asset prices of financial instruments on the market. And also to understand interest rates on the market. The assets are not the same on the market. Interest rates to also be the same. And we even have different markets. And the types of market that we have and the characteristics that is associated with that particular market. And also we look at the structures of interest rates, how it is built and how it changes constantly. And see why it is so difficult to forecast interest rates and financial assets prices accurately. So the main things that we are going to discuss in this topic is these things, these 6 things. Very, very simple. So I want you to understand it very, very well. How these features or how these attributes influences interest rates, and at the end of the day, how it also affects asset prices on the market in terms of marketability, default rates, core privileges, taxation of security income, prepayment risks, and convertibility. How these factors influences interest rate determination on the market. So we are going to take them one after the other. And I want it to be interactive as much as possible. So who will take the first one for me? Let's check. Three males, three females. Raise up your hand. So right, no. I want 6 females, 6 males to raise up their hands. So you take one of them. So 2 people will take one, then we will discuss. This time in exam, you will never forget it. So who is taking what? Why is Nana Kwesi? I've never heard of his voice on this platform before. It's my class. Where are you? Raise up your hand and let me see you. Don't raise up your hand in your room. Where is he?
He's coming.
From where? Then my class rep, where is Vicky?
I'm here.
Vicky, you to raise up your hand. Or let me make it banking and finance.
Madam, I can't hear you.
I think I even went off. Don't worry.
Mm-hmm.
I said, now let's share it equally. The real estate people bring 6 people. Banking and finance, you to bring 6 people, and let's discuss. So real estate, I'm giving you 3 minutes for real estate people to decide. Then banking and finance people, you decide. Put their names on the platform, and I'll call them. I'm giving you 3 minutes to decide on that. Hey, but you close the class, and this topic I won't treat it all. No, not that I will assume it has been taught, or I should give it to you as a.
No, please.
Which one is no, please?
The assignments.
No, let me give it to us. Hello, that is even good. Let me give it to you as a project topic.
No, please. Don't. We are online, but to be active.
I didn't say you are not online. Which squad has come? Victoria, Judith, Manuel, Christabel, AMA, Amma, Samuel, Ophelia. Okay, one squad has come. Where is the other squad? Where is the other squad?
Question. Can you present it?
Okay, now let me. Hello. The banking people. How many are you?
But I'm banking or accounting and finance because I'm really confused.
Whether accounting and finance or banking and finance, you're all finance. So, is it accounting and finance or banking and finance? Accounting and finance.
Yes, please.
Yes.
Okay. How many are you? Here.
Madam, we are 84. Here.
Because the class is, they are 45, including myself.
Yes.
So the students are 44. Since we started, this has been the number. So I don't think we have any other numbers elsewhere. Vicky, your people, how many are you?
Madam, we are 21, but currently here we are just 7 here.
So how many opted for the course? Only 7.
But it's a call for us, so we are supposed to be 21.
Hey.
For my class, we are 21 into. It's
Really?
a call for us. Yes, please.
Okay, so you are only 7 here. Vicky,
Yes.
you and
Between.
this work it will be assignment. Don't worry. I want people to understand it better. So you do presentation on it. Then as you are presenting, then all of us will be commenting. Okay. So next week we are not meeting. Next week is Easter. So
Yes.
Vicky, because you people are few here, the two of choose any two of the
7.
Of the 7. Is it 7 or 6? 7, eh? Choose any two of them. Which one will you choose? Which one will you choose?
The 7.
Which one? Now, another question to us. Oh, I'm concerned. You are giving me feedback, please. Okay, so Vicky, real estate, choose two of the factors that influences interest rates.
1 and 2.
You want which one?
Marketability
And what?
and default.
You want marketability and default rates. So put it in the chat.
Yes.
Now we are left with 6. Nana Kwesi, form a group of 3.
Madam, please come again.
Okay, Nana Kwesi, form a group of 4. Give each of them 1. Let them come and discuss. So we have the core privilege, taxation, prepayment, and convertibility. Form a group of 4 and let me have the names of the group. Put it on the platform. Not here, the hostel platform. And let me know the people in the group. So when we meet on face-to-face, we will use 30 minutes to do the presentation and discussions of it. Okay? Please, I'm doing that so that all of us will understand and appreciate it very well. if I talk, it assumes you people understand, but muja to so when you meet as a group and discuss, at least one or two will stick in your mind because Obiabeka Kakra. Please, are you with me? So the real estate people are 7 here. So they have taken 2 topics. That is marketability and default rates. Now, these factors, you are going to explain it in terms of interest rate determination and also in terms of selling a financial security. That is how you are going to explain it. So when you take marketability, if a security is marketable, how will the interest rate be? Will the interest rate be high or it will be low? Now, if interest rate is high or low, if I want to sell that particular asset, will it be easy for me to sell the asset or not? If it will be easy for me to sell, will the price be high or the price will be low? That is to the discussion. So next we are meeting in next 2 weeks because next week is Easter Monday. So first thing when we meet, we are going to do the discussion. Please, are we okay?
Madam,
Yes.
please, can you please take it again? How?
The assignment. I said that the 6 variables that you see here, right? We are going to use to explain how interest rate is being determined. So if we take marketability, if a financial asset is marketable, what will be its effect or its influence on interest rate? Will it cause the interest rate to be high or it will cause the interest rate to be low? That is what it means. That is one aspect. Now, in terms of selling the financial asset on the market, will it be so easy to sell the financial asset or it will be difficult to sell the financial asset? And how will the pricing of the asset also be? Will it be expensive or it will not be expensive? Are you okay? Now, let me take this out. You see, when you go anywhere, when you even set out in town, look at the type of cars that you see in town, common types of cars. You will normally see Corolla or Toyota cars. One thing about Toyota cars is it's very, very durable, very, very marketable. Who owns Toyota car? And the prices of Toyota cars, because it's quite marketable, its prices. Hello.
Hi, hello.
Yes.
Now, please, your voice is quite behind.
Hey, now my voice, baby, I'm now.
There is a network, or maybe your mouth or your voice has a speaker. Okay.
I said that.
Okay.
I was giving you an example that when you take cars, for instance, you will not see Rolls Royce or Rolls Royce. You won't see Rolls Royce on the market. Then I have those type of products are not easily marketable. Or even one-door cars. When you move through town, how many times you see one-door cars? Those type of cars are not easily marketable. So if they are not easily marketable and you want to buy, when you buy the car and you want to resell it, whom are you going to sell the car to? It will be quite difficult for you to get somebody to buy. Please, you understand? So the marketability of the particular asset determines the price that they put on it. If I go and buy a one-door car at a very expensive price, and today I want to resell it, you won't get a good price on the one-door car because the car is not easily marketable. Do you understand what I'm saying? So when you take a financial asset, if a financial asset is marketable, what does it mean? How does it influence interest rates? Will it set interest rates high or it will set interest rate low? If we talk about convertibility, how will it influence interest rates? How will it influence asset pricing on the market? That is what you are going to do. So please, as for the real estate people, they are only 7. So I don't have a problem with their group formation. But the accounting and finance people, I want to see your group formation on the platform. Please give Nana Kwesi, give every group 1 and let them come and discuss it thoroughly. Please don't bring more more than one page because we are talking about only one variable. So don't go and do internet copy and paste and bring it to me. You don't do that. Okay.
Okay, madam.
Okay, so we will end the class here. Since I've given it to you as an assignment, that will make us to end the class. Okay.
Okay.
Okay, so I wish you all the best. See you in 2 weeks' time, God willing, at the same time.
All right, madam.
Okay.
Madam. Have a nice day too.
You too, my dear. Have a wonderful Easter.
All right.